Hi, I'm Max Phelps and I'm one of the mortgage brokers at Golden Eggs Home Loans. Welcome to our series of videos where we'll help you understand how to buy and hold more property over the long run. Today's topic is offset versus redraw. Now, if you've already heard of an offset account and heard that it's somewhere to have all your pay going into and save money on your home loan, then I'm going to ask you to forget what you've heard so far and start at the beginning with why an offset account exists. To do that, let's look at the difference between building money in an offset versus paying down your home loan with the ability to redraw funds from the overpayment. Now, if you're never ever going to invest in property, there's no difference between the two. But if you're an investor or a first home buyer with potential to keep your first home as a future investment, then there's an important difference. Let me explain. A traditional loan is a bit like a bucket. Let's say you have a loan of $600,000 and you have the ability to pay an extra $100,000 into that loan, which takes the balance down to $500,000. The bank calculates interest daily on the balance of your loan. So when you only owe $500,000, you only get charged interest on $500,000. That $100,000 extra that you've overpaid is often available as redraw, which means that they'll let you have it back out, and depending on the lender, some will even let you have an ATM card to draw that money out. Now, the problem is, if you actually draw the money out, it could have an important consequence. And that's because the ATO sees redraw as a new loan for tax purposes. Let's say this was your first home and you wanted the option to keep it as an investment property when you upgrade to your next home. Now, if you paid $100,000 off that loan while you were living in it and then redrew the $100,000 to put down a deposit on another home, then the bank will say that you've got one loan for $600,000. But the ATO will say that you've got two loans. One loan for $500,000, which is for investment property, and one loan for $100,000, which is for your new owner-occupied property. The bank will be charging you interest on $600,000, but the ATO will say that you can only claim tax deductions on the $500,000. And that's why the offset account was invented. It lets you have a loan account of $600,000 and a separate linked account to it called an offset account, which lets you place the $100,000 in it. The bank will charge you interest on the difference between the two. Technically, it's additional because one is negative and one's positive, but they'll charge you interest on $500,000. That means that while $100,000 is in the offset account, the interest you pay is identical to the redraw scenario. The difference comes when you take the money out from your offset account. You simply use the $100,000 as your deposit for the next home, and all of the interest charged on the original $600,000 balance is tax deductible if you use that first property as an investment. Now, I'm not an accountant. You should speak to a qualified accountant and get your own tax advice. But as an investor, I'd rather have an extra $4,000 to $5,000 as a tax deduction. Now, in part two, we'll look at some of the other benefits of the offset account. Now you understand why an offset account exists, let's look at some of the benefits or strategies you can use to take advantage of them. Firstly, there's paying interest only. If your goal is to upgrade to another home in the future, then building up funds in an offset account is more important than paying down the principal of your temporary home until you find a newer home. There's always a possibility that you may want to keep your current property as a long-term investment. So why not build up funds in the offset account to give yourself a bigger deposit for your future home and pay interest only on the loans you use to purchase your current property with. And that means the loan stays the same. The risk with interest only is that the loan will not be reduced during the interest only period, a risk we'll explain in chapter 3. The second strategy is borrowing more than you need. Instead of borrowing the least amount possible on your first home, you can borrow as much as possible given the constraints of borrowing power and lender's mortgage insurance. In the extreme case, for those using a guarantor, you can actually borrow 100% of the purchase price plus costs of your first home and keep all your current savings ready to use as a deposit for your future home in your offset account. Because the bank will only charge you interest on the difference between the loan and the offset account, it will be the same as if you borrowed the least amount of money. The third strategy is holding a buffer. There are various risks to owning a property, explained in a different video, several of which can be mitigated by holding a buffer. A buffer is simply leftover funds that you can keep in your offset account that can be used to cover unforeseen expenses or a temporary reduction in income. Holding these funds in an offset account just means that you'll be able to use them without affecting the future tax deductibility of the loan. In part 3, we'll look at managing the risks, both of paying interest only and of having your funds in an offset account. So far, we've seen why an offset account exists and some of the benefits, but there's one big risk of having an offset account and an additional risk if the loan is interest only. The big risk of having an offset account versus paying down the loan is spending your savings. I cringe when I hear bankers tell you that you can pay all of your pay into the offset and pay all of your bills, or worse still, your credit card, from it. In my experience of dealing with a lot of people's finances, this is a dreadful idea. Technically, you'll save a tiny bit of extra interest, but the reality is that most people save best when their savings are kept out of sight. When you go to the ATM to see the money in your account, imagine if you could see your $50,000 offset account at the same time, and you're thinking, can I pull out $200 or $500 or whatever, and you've got $50,000 sitting there. Well, why not? If the biggest risk with an offset account is spending your savings, then keep them separate with no ATM access. And if there's two of you, you could even make the offset account in a both to sign instead of either to sign. You can still access your offset accounts, but you have to have an adult conversation about it rather than just dipping into it on a whim. The second thing I'd like to recommend is you make payments from your normal bank account into your offset account as if you're paying principal interest. Actually, as if you're paying principal interest at maybe 7 or 7.5%, which is what interest rates could get up to. If you put that money into your offset account, that's like your savings. And then the offset account simply pays interest only on the loan, and you build up on the interest every month. By doing this, your offset account will build up really, really fast, or at least as fast as the principal would have been reduced by. And that's what will give you the deposit for your next home. Whereas if you put paying your bills through the offset account, the chances are your offset account won't go up very fast. You won't be in a position to buy your next property. So if anyone asks you if you want an offset account, the question you need to ask is this property an investment property, or could it ever be? Even if you're living in the property now and later it could be an investment property. I'm Max Phelps from Golden Eggs Home Loans, where we like to help you grow your golden eggs.